And disappointing day yesterday, considering we were once again counting down to that 25,000 mark on the Nifty, and then again fell flat from there. In fact, we gave up all of our morning gains and closed in just about flat in trade, dipped a little bit into the red and then surfaced from there. Having said that, the broad end of the market once again was a lot better than what the benchmarks were doing and what the large cap end of the market was up to. In fact, the market cap of the BSE listed companies managed to hit a record high for itself as well. You had power, oil and gas, all of them advanced, and crude derivatives did see a bit of a cool off overnight over the weekend, and then again a pickup overnight yesterday. The derivatives, that is. So they're the ones which were soaring, considering there was that bit of a dip that played out on crude prices. So that's pretty much it. And yeah, we're back to a sell figure from FIIs, which was as large as over 5,000 crores yesterday, Nikunj. DIIs, they continue to buy India.
You know, I'm scanning through like heaps and heaps of paper.
Yeah, I can see that. Yeah. What are you doing?
No, I'm trying to find a trend. I'm really trying to find a trend. All I'm saying is that if you look at yesterday's market in isolation, frankly, nothing is different in terms of the general participation or general narrative. What are markets telling you? Markets are telling you that, look, there is plenty of support stroke liquidity at higher level. At the top end of the market, there is a bit of nervousness, temptation to book profit, and perhaps stickiness which is coming ahead of Fed meeting. So if you look at yesterday's market in isolation, yes, we may have cracked from the day's high, but if you look at market, let's say post budget, I guess the trend is very clear, which is that we are moving in a rather predictable manner, which is that on bad days, buy the market, don't expect large gains. There is a lot of sectoral churn which is clearly evident in the market, and global cues also are stable, which in a sense are giving this kind of a market some stickiness. So the bottom line here is that you should not be in a hurry to say, okay, this is the market top. Bottom line here is that you should not also be in a hurry to put large amount of allocation that markets are not cheap. So stay with the market. Don't try and preempt that what is next. All you need to do is that understand risk. All you need to understand is that how to benefit from the churn, and as long as global cues are stable, nothing happens locally, I think there is reason to believe that this trend will continue.
Okay, fair enough. So that's basis all of the notes that you have managed to cull out with respect to how one should be.
Nothing new, no? Nothing new.
Nothing new.
So much of like 60-page reading in the morning.
Still no trend.
Yeah, but perhaps you will be able to call out some details when it comes to what has happened with Sebi, as they have come ahead and cracked down on F&O trading. In fact, they have proposed now tighter derivatives regulations in order to boost market stability and protect small investors. This consultation paper was released just yesterday. They're including increasing the contract sizes by as much as 4 times, collecting options premium upfront, and they've also spoken about reducing the number of weekly contracts, Nikunj. So big changes coming in.
Okay, again, these are proposed changes, so they are not the final.
It's a consultation
paper. Let's see how much of that it gets implemented. Now, what is the thought and what is the reasoning? Well, it's very simple. The options activity in the market right now is at a record high, and the way the options market has seen retail participation post-COVID, I think the surge is not just a deep swell, it's an extraordinary jump. Data and anecdotal data has clearly indicated that in the options market, and if you take the sophisticated institutional investors out, only 15% of the non-institutional clients have made money. But the temptation to make quick money in such a strong bull market is always there, and we've seen what could be called as mass participation by retail crowd who are ignoring risk and who are completely giving a blind eye to the reality of risk in the financial market. So what Sebi is doing, I guess, is correct. You have to sometimes have a carrot approach, sometimes a stick approach, sometimes you have to create guardrails, and the attempt here is in a sense to really cool down the speculative activity in the F&O market before it blows out and becomes like a systemic risk. SEBI's main job is to do market risk management. Now what are they trying to do? Very simple. To reduce volatility or reduce participation, not volatility but participation, and bring the activity level down, make changes on the lines of reducing weekly contract, increase the lot size, which will make it difficult for, or which will only entail that the serious traders in a sense are participating, then come out with changes when it comes to on the expiry day and out of money and on the money. So this in a sense will have impact, and the impact I think will, if implemented, clearly will have an impact on the volumes. So that's the attempt here. Why SEBI is doing it and what are they trying to do? Now the third leg. So there is three legs. One, why are they doing it? What are they doing? And the impact. If all that is implemented, of course, trading volumes will come down because margins will have to be paid out more. If you're buying a lot, the lot will be expensive. So instead of participating, you would say, look, I can't afford it. So obviously it will have an impact on all that. If you make the cost of transaction higher, very simple. What happens now? Brokerages. So institutional brokerages will not have large impact. Because for them, it's like, prop book management, institutional back management, family office money they are managing. So for them, they understand risk, and for them, it's all right. But retail brokerages will have an impact. The Zerodha, the Angel, the small non-listed ones, I think there the impact is going to be there. There is data which you'll have to look at, that what could be the real impact. I'm looking at a report from Jeff Investec, which talks about Angel. Yeah. So it would be very individual. But needless to say that for brokerages who essentially have a retail dominated, large pie coming from them, if these laws are implemented in the near term, surely it will have an impact in the way how the business and the stock price would move.
The absolutely. Orders per client might reduce.
Yeah, in fact, Investec is saying that it's a little too early to try and quantify the impact. They're saying that there are multiple moving parts. The impact they are also saying is going to be seen on lot sizes, margin increases. But what they're saying is that they, expect Angel One to hike prices to 25 rupees per order from the current 20. So I think in terms of brokerages, Nikunj, the cost is going to be passed on, as simple as that.
Yes, if cost, you have to also realize that the options market is a very sensitive market. It's a very sensitive market where spreads are thin.
To each paisa, literally.
Yeah, the spreads are very thin, right? So if you increase the cost, the whole proposition of making that that extra spread advantage or that extra profit comes down. So obviously it will have an impact on profit. See, what drives participation? Proposition of profit and affordability. If proposition of profit comes down, which is spreads or cost goes down, and if the spreads reduce, the activity levels could reduce. We are assuming that all this will go through, but if it goes through in the near term, it surely will have impact on it. But you never know. If markets remain strong, their volumes could actually come back. But in the near term, if you really want to look at the impact would be felt by retail brokerage firms. And I can count, I think Angel is one, which is the other one? Motilal Oswal, Quasar, actually there were a lot of other businesses. Yeah. Zerodha, it's not listed. But the impact really would be felt by retail facing brokerages in terms of the immediate short term impact.